Here is a number your lender never shows you on closing day. Over the lifetime of a standard 30-year mortgage, the average American homebuyer pays back nearly 2.5 times what they borrowed. The bank isn't just lending you money, it's running a business. And you are the product. Let's start at the beginning. When you take out a mortgage, you're not simply borrowing $300,000 and paying it back in equal chunks. What you're entering into is called an amortization schedule, and it is specifically designed to collect the most interest possible in the earliest years of your loan. Here's how amortization works. In your very first monthly payment on a 30-year, $300,000 loan at 7% interest, roughly $1,750 of your payment goes to interest. Only $250 goes to actually paying down your loan balance. You read that right. In month 1, only 12 cents of every dollar you pay reduces what you owe. The rest, 88 cents, goes directly to the bank. This flips over time. In your final years of payments, almost everything goes to principal. But by then, the bank has already collected its profit. This is called front-loading interest, and every standard mortgage does it. It's not illegal. It's not even hidden. It's just how the math works. But here is what matters. Knowing this changes how you should think about every decision involving your home loan, from when to refinance, to how to make extra payments, to whether to pay points at closing. Chapter 2. The refinancing game. At some point in your mortgage journey, someone is going to tell you to refinance. Your lender might call you. Your neighbor might brag about getting a lower rate. And yes, refinancing can absolutely save you money. But it can also cost you tens of thousands of dollars if you don't know what you're doing. Here's the trap most people miss. When you refinance, you restart your amortization clock. Say you've been paying your mortgage for 8 years. You finally reach the point where your payments are roughly 50-50, half interest, half principal. Now you refinance into a brand new 30-year loan. Congratulations. You just reset back to year 1, where 87 cents of every dollar goes to the bank again. So when does refinancing actually make sense? The answer comes down to one number, the break-even point. To calculate it, take your total closing costs, usually 2 to 5% of the loan, and divide by your monthly savings from the lower rate. If you plan to stay in the home longer than that break-even period, refinancing works in your favor. If not, you're paying money to save money you'll never actually see. Chapter 3. Interest rate versus APR, and why this distinction could cost you $20,000. When you're shopping for a mortgage, you'll see two numbers, the interest rate and the APR. Most people focus on the interest rate because it's the lower number. That is exactly what lenders want you to do. The APR, annual percentage rate, is the true cost of borrowing. It includes not just the interest, but also mortgage points, origination fees, broker fees, and certain closing costs, all rolled into one annualized rate. A loan with a 6.5% interest rate might carry a 6.9% APR once you add in all the lender fees. When you're comparing two loans, always compare the APR, not the rate, the APR. And while we're here, be careful about mortgage points. Buying a point means you pay 1% of the loan up front in exchange for a lower rate. 1 point on a $300,000 loan costs $3,000. That might buy you a 0.25% rate reduction. Depending on your loan and how long you keep it, that break-even can take 8 to 12 years. Run the math before you buy points. Chapter 4. Extra principal payments. The single most powerful tool available to any homeowner, and one most people never use. If you take nothing else from this video, take this. Making even small extra payments directly to your mortgage principal can save you tens of thousands of dollars and shave years off your loan. Here's why it works. Let's go back to that $300,000 30-year loan at 7%. Your monthly payment is around $1,996. Now say you add just $200 extra to the principal every month. That extra $200 doesn't just sit there, it immediately reduces the balance on which future interest is calculated. Over the life of your loan, that $200 a month in extra payments saves you approximately $76,000 in interest and pays off your mortgage more than 5 years early. $200 a month, $76,000 saved. One critical rule: when you make extra payments, specifically designate them as principal-only payments. If you don't, some lenders will apply the extra money to next month's interest first. Contact your servicer, log into your account, check the payment options. Make sure that extra dollar is hitting your principal, not disappearing into the bank's pocket. Chapter 5. The Closing Cost Trap. You've found the home, you've been approved for the loan, the rate looks good. Then, 3 days before closing, you get a document called the Closing Disclosure. And buried in it, sometimes spread across multiple pages, are fees you've never heard of. Origination fees, underwriting fees, processing fees, document preparation fees, rate lock fees. These are not standardized, they are not regulated, and they are absolutely negotiable. Closing costs typically run 2 to 5% of the loan value. On a $300,000 purchase, that's $6,000 to $15,000 in fees. Some of these you cannot avoid: government recording fees, transfer taxes, title insurance. But lender fees? Those are on the table. Ask your lender to waive the origination fee. Ask for a competing loan estimate from at least 2 other lenders. Even shaving $2,000 off closing costs means that's $2,000 that stays in your pocket on day 1. One more thing about closing costs. Some lenders will offer to roll them into the loan, meaning you don't pay them out of pocket, but they get added to your principal balance. At first, this sounds attractive, but remember, you then pay interest on those fees for 30 years. A $6,000 closing cost rolled into a 7% loan costs you nearly $14,000 over the life of the loan. Always pay closing costs out of pocket if you can afford to. Let's bring this home. Your mortgage is likely the largest financial commitment of your life, and the system it operates within is not neutral. It is designed to extract maximum value from the borrower. But here's the thing. Every piece of knowledge you just absorbed is a weapon. Understand amortization, and you know why the early years of your mortgage are the most important to attack. Know the break-even on refinancing, and you'll never get tricked into paying thousands in fees for a loan that doesn't help you. Compare APR instead of rate, and you'll never get fooled by a low teaser number. Make extra principal payments, even small ones, and you'll save money other homeowners never see. Negotiate closing costs, get competing offers, and keep more of your cash on day 1. This channel exists because most people go through the biggest purchase of their lives without anyone explaining how any of this actually works. If this video gave you something useful, a new way to look at your loan, a number you didn't know, a question you now know to ask, subscribe. We cover mortgages, refinancing, loans, and the financial moves that protect your money. The next video is already waiting for you.